I'm sorry. Hello, everyone. Welcome. I'm hoping that you had a great day today in your buildings. We're so proud to bring you this presentation. It is so vital to our members, and we're glad that you're here. And we thank the Municipal. We thank Jack Silver because he is our committee chair. I am the liaison and an organizer with the Chicago Teachers Union. I just want to say again, thank you. And I'm just excited about this, and I'm hoping that you gain a lot from today. Again, thank you.
The chair of the pension committee, would you like to say just a couple of words of introduction?
Yes, I would. I'd like to thank all of you for attending this meeting. I know how important this is to find out about your pensions. And just want to tell you a little history. We've been having these meetings for a long time now. And this year we're going to have 2 meetings this year, one now and another one in June. And I want to thank you for coming today. And I also like to thank the officers of the Chicago Teachers Union who allowed me and the Pension Insurance Committee to get you this information. And I also like to thank LaShawn Wallace, who is my liaison with the Chicago Teachers Union, for assisting me. And I also like to thank Nate Goldbaum as well from the Communications Department. And enough about all these introductions. I know you.
Before that, I think we do want to hear from our PSRP for life, our recording secretary, Crystal Williams-Hayes. Is that all right?
Yes, please.
Hey, everybody. Good afternoon. And as Nate says, yes, I am a proud PSRP for life. I was a school clerk for 17 years out of almost the 30 that I've spent with CPS. And I'm proud of that moment. And I'm really excited to hear what's going to be said today. I think this is important. If you've been in this system for a while, like me and LaShawn and some other paras that work at the union, this is good news. This is good news. So just take it, all the information that they're sharing. Please be sure to ask questions. I'm here if you have questions from me. And yes, I am the recording secretary. I did forget to mention that. And the first paraprofessional of color to hold that position. So it's a proud moment for me. And I hope to be able to do this for a little more while. Thank you all so much.
I'd like to introduce Mr. Lateef Moody. He's a senior pension benefits counselor at the Chicago Municipal Fund. He's been our liaison for quite a few years, and he's the go-to man. He's my go-to man whenever I need information on the municipal funds. And today he's going to educate you about the funds, and he's going to tell you what he's going to be telling you about in pre-retirement information. And I hope you get some useful information out of this. And I'd like to thank you all again for attending. And I'd like to turn the meeting now over to Lateef. Thank you, Lateef.
No, thank you, Jack, and thank you all, and good evening, everyone. Welcome to our pre-retirement session. What do you know about retirement? Presented by the Chicago Teachers Union, along with the Municipal Employees Annuity and Benefit Fund of Chicago. So as Jack said, I am Lateef Moody. I am a senior pension benefits counselor in the benefits department of the fund. So before I get going, I want to go through our disclaimer. Actually, before I do the disclaimer, I want to let you know that I'm going to do about 20 minutes or so of Q&A after the presentation. So you can type your questions into the Q&A session, and I will answer as many questions as I can following the presentation. So now on to the disclaimer. So this presentation was created by the fund to make available general information about the benefits provided by Illinois law to the members of the fund, you the members. However, this presentation is not an official reference source and should not be relied upon as the sole source of information regarding benefit entitlement. So just please be mindful that this is general information. So the law enacted by the Illinois General Assembly is the official authority and primary reference regarding this fund. If there is any conflict between this presentation and the law prevails. And the information contained in this presentation is summary in nature. So please be mindful of that. We can't cover every single instance of everything that's going to be going on, but this offers us a summary for you all. And so then to scroll down a bit, therefore, users of the presentation are advised of their responsibility to contact the municipal fund directly for specific information relating to benefits and to confirm the accuracy and completeness of the posted information. And lastly, MEABF has no liability with respect to any actions taken as a result of or in connection with the information contained within. So these presentations are great. They give you a good summary of what your benefits would look like and give you good general information, but please be mindful, this is not a substitute for contacting our office, getting a pension estimate, and speaking with a counselor like myself. Okay, so the first thing to understand about retirement really is retirement eligibility. Okay, so I would imagine that many of you all are what are called Tier 1 members of the pension fund. So Tier 1 members are anyone who was hired prior to January 1st of 2011. So if you were hired before that date, you are a Tier 1 member of the fund. And here is the eligibility for Tier 1 members. If you are at least age 50 with at least 30 years of service, you're eligible for retirement with an unreduced benefit. If you are age 55 with 20 years of service, you're eligible for a reduced benefit. And later on, I will show you some examples of a reduced benefit and an unreduced, so you can see the difference later on. If you are age 55 with at least 25 years of service, that's also an unreduced benefit. And if you are age 60 with 10 years of service, that is also an unreduced benefit. So the pension contribution is a 9% contribution for Tier 1 members. Now, in most situations, most positions, that tends to be a 2%, 7% split, where you, the member, contribute 2% and your employer is contributing 7% for a total 9% contribution. You can very often see this split on your pay stubs. And then when we calculate your pension, we use a 4-year final average salary. We take an average of the highest 4 consecutive salaries out of your last 10 years of work. And I'll show you some examples later about how we calculate the final average salary. Now, also, I want to note for this presentation, this is primarily a Tier 1 presentation. This is geared towards Tier 1 members. But if you are a Tier 2 or Tier 3 member, please still stay tuned because this presentation will still contain a lot of good information for you. Now let's look at the Tier 2 breakdown. Now, Tier 2 members are members who began employment between January 1st of 2011 and July 5th of 2017. So if you began employment within that window, you're a Tier 2 member of the fund. So for Tier 2 members, the breakdown is very different than Tier 1. So for Tier 2, you must be at least age 62 with 10 years of service for a reduced benefit, and then age 67 with at least 10 years of service for an unreduced benefit. Once again, the pension contribution is 9%. And once again, typically it's either a 2%, 7% split, or it might even be a 4%, 5% split, where you, the member, contribute 4% and CPS contributes 5%. And then instead of a 4-year final average salary for Tier 2 members, it's an 8-year final average salary. Highest 8 consecutive salaries out of your last 10 years worked. And Tier 3 members. So Tier 3 members are anyone who began employment July 6th of 2017 and then after. So for Tier 3 members, it's an age 60 with 10 years of service qualifies them for a reduced benefit, and age 65 with 10 years of service qualifies them for an unreduced benefit. Now, compared to Tier 2 members, since Tier 3 members are able to retire earlier than Tier 2 members, they contribute more. So instead of a 9% contribution, there's a 12% contribution. And once again, typically it can be a 5% split, 7% split, where the member contributes 5% and then the employer contributes 7%, for a total 12% contribution. And once again, just like tier 2, there is an 8-year final average salary. Okay, so this is the lineup of topics I'll be covering today. So for course, number 1, we'll talk about pensions. Number 2, I'll talk about 2 types of refunds that you can be eligible for potentially. Either a lump sum refund instead of your pension contributions, and also a spousal, or what's called a spousal refund of your contributions. We'll talk about that. Also, I'll talk about reciprocity, retiring under reciprocity. I'll go through that. An important topic, COLA, your cost of living adjustment, or what's also called your automatic annual increase. I'll go through that. So surviving spouse annuities. I'll go through disability benefits, give you a little bit of information on that. I'll show you examples about how a pension is calculated. And also I'll talk about the application process, and then kind of a little known topic called the reversionary annuity. I'll talk about that too. Okay, so now let's get into our breakdown once again of pensions. So once again, if you are between the ages of 50 and 54 and you have at least 30 years of service, once again, this is for tier 1 members, you're eligible for retirement. If you are between the ages of 55 and 59 with at least 10 years of service, you're eligible for a benefit. And then if you separate from service at age 60 or older with any years of service, you're eligible for a benefit. And you'll notice tonight that I use the word separate a lot. I don't say resign, because some people, a very common misconception that I hear a lot is people think that if they are terminated from employment, that they're not eligible for their pension, or they're going to lose out on something if they're terminated versus resigning voluntarily. So I use the word separate a lot, because you qualify for the same things whether you separate from employment voluntarily or involuntarily. So I use that word a lot. Now, the first benefit I'll talk about is what's called a money purchase benefit. So a money purchase benefit is for members who separate from employment and they're between the ages of 55 and 59 with at least 10 years of service, but less than 20 years of service. Or if you separate from employment and you're at least age 60 and you have less than 10 years of service, then you only qualify for the money purchase benefit. So to dig into this a little bit further, a money purchase benefit is essentially a lifetime expectancy calculation where we take your age and the amount of money you've contributed and calculate a benefit based on your life expectancy, okay, how long you're expected to live. Now, the thing about a money purchase benefit is that it tends to be only a few $100s a month. Not to say that happens in every case, but whenever I've calculated a money purchase benefit, it typically is $300, $400 a month. And it may not be for life. It might only be for a certain number of years and months. So this is not the ideal situation. Most members don't fall into this category, but I want to make sure that you're aware that if you separate between 55 and 59, 10 years of service, but less than 20, or you separate at age 60 or older and you have less than 10 years, this is the monthly benefit that you qualify for. But most people don't end up with a money purchase benefit. Okay, so now let's talk about the minimum formula, where most people do fall into this category, and how we calculate your pension with what's called the minimum formula. It's based on 3 factors. It's based on your age, based on the 4-year final average salary. And once again, I'll show you some examples later on about how we calculated the 4-year final average salary. And based into also your years of service, how much time you have paid into the pension fund. So these are the 3 factors we use to calculate your final average salary. Now let's look at this also. So I'll talk about the service credit. So service credit is calculated using calendar years. So we don't do school years or fiscal years. We look at calendar years when we're calculating your pension. And the first thing is, if you work at least 1 full month in a calendar year, so for example, every year, when you work the entire month of January, you receive your first half of service for the year. So if you work 1 entire month in a calendar year, we give you 6 months of credit, okay? And then the other thing is, when you work 6 months in the calendar year, so for example, if you work January through June, you get your full year of service every year in June. So this is why at the pension fund, every year we see a ton of people retire June 30th. They retire at the end of June, because they understand that pension-wise, that's their pension for the year, because they have their full year of service in June. And so they understand that pension-wise, nothing is gained by staying until November or December, because they know that November or December is the same pension amount that it was 5 months earlier in June. So every year, when you work 6 months in the year, you get your full year of service at that point. Okay, the minimum annuity. So this is important. So if you separate from service and you're at least age 60 and you have at least 10 years of service, you qualify for a minimum monthly pension of $850 a month for life. Okay, but you have to separate from service at least age 60 with at least 10 years of service. So if you do both of those things, then you qualify for at least $850 a month for life. Okay, so the maximum benefit. The maximum benefit is if you retire and you're at least age 50 and you have at least 33 and a half years of service. So at 33 and a half years of service at age 50, you are eligible for 80% of that 4-year final average salary. And the reason for this is because our multiplier that you'll see in a few minutes when I do some examples is 2.4%. If you take 33 and a half and multiply it by 2.4, that's 80. So that's how you end up with 80% at 33 and a half years. You end up with 80% of your 4-year final average salary. Okay, so now let's talk about the important topic, deferring your pension. So let's say that you separate from service and you have at least 10 years of service at that point when you separate. If you have at least 10 years of service, but you're not yet age eligible, you're not yet age 50, or you're not age 55, or you're not yet age 60, you have the option of what's called deferring your pension, where you can leave your years of service, you can leave your money with the pension fund until you reach that age eligibility. And then at that point, you can apply for retirement. So yeah, it's an option we have called deferring your pension. So you absolutely can leave your contributions with us until you reach the age in which you are eligible for a pension benefit. Now, one thing to note about this is that anytime you leave your contributions with us, they don't receive statutory interest until they are used for pension purposes at a later date. Okay, so now let's talk about refunds. So let's say that you separate from service and you are not vested. Vested means that you didn't reach 10 years of service and you don't qualify for a pension benefit. So if you separate from service, you're under age 60, you didn't get to 10 years of service. So in that instance, you can apply for a lump sum refund of your pension contributions. And that money is refunded to you with 3% statutory interest up to the date that you separated from service. So if you separate from service and you're not yet eligible for pension, or you didn't get to 10 years of service, you can absolutely apply for a one-time lump sum refund of your pension contributions. Now, one thing to note, though, is that if you separate from service and you are pension eligible, and if your pension is calculated to be less than $800 per month, you do have the option of taking a refund instead of taking a monthly pension. Now, once again, this is the case where you separate from service, you are eligible for pension, and your pension is calculated to be less than $800 per month. If you fall into that category, instead of taking the monthly pension, you can choose instead to take a one-time lump sum refund of your pension contributions. You do have that option. However, if you separate from service and you are pension eligible and your pension is at least $800 per month, in that instance, by pension law, you have to take the pension. You're not allowed to take a lump sum refund. If you are eligible for pension and your pension would be at least $800 a month, you have to take the pension. Okay, another type of refund. This is called the spousal refund, or the nickname we even give it is the no spouse refund. So if you are single at the time that you separate from service and then apply for pension, you will receive a refund, a lump sum refund of your spousal contributions. This is in addition to a monthly pension. This is a one-time lump sum refund. Now, one misconception is the idea of what single means. So let me clearly define what we at the pension fund call single. Single means you've never been married. Single also means divorced. Single also means widowed. For our purposes, single does not mean you are married, but you haven't seen your spouse in 15 years. We don't count that as single. Now, if you want to, you can call that single if you want, but for our purposes, in that instance, you are married. So in an instance like that, you would not receive the lump sum of the spousal contributions. Whenever a member is married when they retire or separate from service, the spousal money stays with the fund, and it's used to fund a survivor benefit in the event of your death for your spouse. Okay, so either type of refund, the spousal money refund, the spousal refund, or the lump sum refund of the contributions I talked about, either refund has tax implications. So any taxable portion of a refund not rolled over into another qualified tax deferred plan has to have, by IRS law, 20% withheld off the top. So let's say, for example, you're taking a lump sum refund and it's going to be $10,000. Well, if you choose not to do a rollover, if you have the money made payable to yourself, automatically, by law, the pension fund has to take 20% off the top of that in taxes. So instead of getting a $10,000 refund, you would get $8,000 in this example, because we would have to take $2,000 out of the $10,000 in taxes. So in that instance, you would receive a refund of $8,000. In addition to this, if you are under age 59 and a half at the time that you take the refund, you may be liable for an additional 10% tax penalty when you file your taxes the following year. So bear in mind that if you don't roll the money over into what's called a tax deferred account, the money is heavily taxed. Okay, another instance about refunds. Sometimes there can be members who separate from employment, and in some cases this is years ago. They worked for CPS, they separated from employment, and then they took over that lump sum refund of their pension contributions. Well, one of the big consequences of taking a refund is that you forfeit your years of service. So if you take a refund on your contributions, however many years of service you have at that point, you forfeit them. And sometimes people do this. They leave employment to take a refund, thinking that they'll never work for CPS ever again. But then sometime down the road, they end up back at CPS, which is fine. But the issue is that they now no longer have those years of service they had before because they took a refund. So in those instances, you do, and if you want to back in employment with CPS, you do have the option of paying that refund back to get those years of service back. So if you are interested in refund repayment, you can absolutely contact our office about that. We can send you a bill for the cost to buy back that time as of that date. Now, there is interest involved in paying back a refund, so just bear that in mind too. So if you took a refund 10 years ago, 15 years ago, and you want to pay the refund back, just be mindful that you will have to pay that refund back with interest. It's 3% interest compounded annually. So just bear that in mind. And if you are interested in refund repayment, you must pay that refund back within 90 days of the date that you again separate from service. So if you're interested in refund repayment, you can absolutely contact our office and we will send you a bill to pay back that refund. Okay, so now let's talk about reciprocity. So in addition to our pension fund, there are 11 other pension funds here in Illinois that fall under a piece of legislation called the Illinois Reciprocal Act. You can even Google the Illinois Reciprocal Act and read up on it some more on your own. But here's a list of the 11 other pension funds that share reciprocity with the Municipal Pension Fund. The ones I tend to see the most are, for example, the Cook County Pension Fund. I see them a lot, or I see instances of the working, of course, with the Chicago Teachers Pension Fund. I work with them a lot. And then also the State Employees Fund. So there are, like I said, several funds you see here. Now, if you have at least 1 year of service with these funds, or one of these funds or more, then that time can be combined with your current years of service to retire under what is called reciprocity. We would call this a reciprocal retirement. So let's say, for example, that somebody wants to retire with 20 years of service. So if you have 12 years with CPS and then another 8 years with the county, you can take your 12 years with our fund and the 8 years with the Cook County Pension Fund and combine them together, and that makes 20 years. And under reciprocity, what happens is you will submit retirement applications to both or all funds, in case it's more than 2 funds. You'll submit retirement applications to each fund, and then each fund will pay their portion of your pension. Very often people think that if they retire under reciprocity, they're just going to get 1 monthly pension check. No, you'll get at least 2, depending on how many pension funds you're retiring under. But that's what's called retiring under reciprocity. And also note that if you know you've worked under one of these funds previously and you took a refund from those funds, you could contact any of these funds about paying back that refund to that pension fund, to that reciprocal fund, and then you would qualify for retiring under reciprocity as long as it's at least 1 year of service in that fund. So reciprocity is just a really, really great benefit. Another great thing about reciprocity too is that, let's say that you worked for the state, employees, you contributed to the state employees retirement system very early in your career, 20, 25 years ago. The great thing is that if you retire under reciprocity, and you retire under both pension funds, in this example, the state fund would use our current 4-year final average salary for you to calculate how much they would pay you in pension. So in this example, like I said, if you worked for the state 20, 25 years ago, and you retire under reciprocity, your pension from the state employees fund would not be based on your salary 20, 25 years ago. It'd be based on your current salary. So that's one of the great things about reciprocity. So it's just an awesome, fantastic benefit. Okay, so now let's talk about a very important topic people love to ask about, and they should, and that is what's called your cost of living adjustment, or a COLA. Another phrase that's used to describe it is the automatic annual increase. So AAI or COLA, they're the same thing. So it's a 3% compound increase. So what that means is that every year when you receive your COLA, once you're eligible and you start receiving it every January, you receive not just the same amount, not the same 3% every year, you receive 3% off of the prior year. So once you've been retired 10, 15 years, your 3% COLA is a wonderful, wonderful benefit. I use the example that my father is a retired Cook County sheriff. So he retired with the Cook County Pension Fund. He's been retired over 20 years now. So he loves his annual 3% increase. He really looks forward to seeing that every year. It's a really wonderful thing. So you're eligible to receive the COLA in the January following your retirement, provided that you are at least age 59 and you retire no later than November 30th of that year. So this is something that we deal with every year with members and we just make people aware of these rules, these laws. And it's, of course, your retirement date is up to you, but we just let people know this and want to make sure that they're aware of it. So let's say, for example, that someone is 59 years of age currently, and they're going to retire this year. They've already had their birthday for this year, and they're 59 years old. So as long as they retire by November 30th of this year, they will begin receiving their 3% COLA this coming January of 2023, as long as they retire by November 30th. But in this example, if they retire this December, which they can do, once again, once you're eligible for retirement, your retirement date is up to you. It's totally your decision. But if they're 59 years of age and they retire this December, their COLA will not start until January of 2024. If they retire in December, they're going to miss out on the 2023 COLA. So just something to be aware of, that whenever you retire, if you're 59 years of age or older, it's best to retire by November 30th of that year. That way, your 3% COLA can start that following January. If you're 59 or older and you retire in December, you will lose out on the first year of that 3% increase. So you might say, well, wait a second, what if I'm under age 59 and I'm going to retire? How does the COLA work for me? So here's how that breaks down. So if you're under age 60 on the first anniversary date of your retirement, your COLA begins, in this first situation, it begins on your 60th birthday if it's earlier than the third anniversary of your retirement. So you might say, okay, what does that mean? Here's an example. So let's say that somebody retires this year and they're age 58. And they've already had their birthday, so they're retiring this year at age 58. Well, if they're age 58 this year and they've already had their birthday, that means that they're going to turn age 60 in 2024. So if they retire this year at age 58, and then they're going to turn 60 the year after next in 2024, since 2024 is the year in which they'll turn age 60, in January of 2024, they will begin receiving their annual 3% increase, since they'll be age 60 in 2024. And then also you see there in the second bullet point, number 2, it'll begin the later of the third anniversary of retirement or age 53. So let's say that someone is going to retire this year at age 51. Once again, they've already had the birthday. They're going to retire this year at age 51. So the third anniversary of their retirement is 2025. So in this example, age 51 retiring this year, in January of 2025, they will begin receiving their annual 3% increase, because 2025 is the third anniversary of their retirement. All right, so a couple of things to also to note about COLAs is that you'll begin receiving it in the January of the year that you become eligible. Now, if you are receiving a term annuity, now that would be a money purchase, like I described earlier, a money purchase that is not for life, because like as I said earlier, sometimes the money purchase benefit is only for a certain number of years and months. So if you're receiving a money purchase benefit that is not for life, you're not entitled to a COLA. Also, surviving spouses are not entitled to a COLA. And if we have a minor child receiving what's called a child annuity, a minor child being a child that's under the age of 18, they also are not entitled to a COLA. So the thing to keep in mind about the COLA is that the closer you are to age 60, the shorter your wait is before the COLA will begin, and your wait will be no longer than your third anniversary of retirement. You will wait no longer than 3 years after you retire before the COLA will begin. Okay, let's talk about death benefits a bit. So for death in service or after retirement, generally speaking, the surviving spouse is entitled to half of the employee's benefit at the time of their death. Okay, a couple of the notes about surviving spouse annuities. The minimum benefit is $800 per month for the death of a member who died while still actively working with at least 5 years of service at that time of their death. And the minimum is also $800 per month for a retired member who died and had at least 10 years of service. Also, for death in service, a member who dies while they're still actively working or after they have separated from service, the spousal annuity is limited to 50% of the employee's highest salary. Okay, so now let's talk about disability benefits. This is an important topic too. So here at the fund, we have two types of disability. We have what's called ordinary or non-duty disability, where you have an injury or accident that is not related to your job. And then you have what's called duty disability, which is kind of what it sounds like, where you have some type of injury that is work related. Now, if it's ordinary disability, you're entitled to 50% of your salary at the time. And if it's a duty disability benefit, you're entitled to 75% of your salary, less the workers' compensation portion. So with duty disability, what happens is workers' compensation will pay 66 2/3% of the benefit, and our fund will pay 8 1/3%. Because when you take 66 2/3 and add it to 8 1/3, that makes 75. Okay, next note. Now, for disability benefits, to receive pension credit while you're on an approved disability, that means that it's been approved by your job and approved by us. You must apply for disability with the fund. Here's an example. I dealt with someone once who called the office and they had been on disability with their job for 3 years, for the past 3 years, but they never called the pension fund to apply for disability with us also. So unfortunately, in her case, she was losing out on service credit. It was very, very unfortunate because she did not know that she needed to apply for disability benefits with the fund also in order to continue to earn service credit while she was on disability. So it's very, very important. So if you find yourself applying for some type of disability benefit with your employer, contact the pension fund also and apply for disability benefits with us too, so that you can receive service credit and so that you can receive disability benefits from the pension fund. The reason this is so important is that disability benefits can only be backdated 1 year from the date that you apply. So to go back to this example from a second ago, with this person who had missed out or had been on disability for 3 years and had not applied for the benefit, we were only able to give her retroactive benefits 1 year prior, back to 1 year prior. So she missed out on not only 2 years of 2 years of disability benefits, she also missed out on 2 years of service credit. She couldn't get that back. She missed it. So it's very, very important that if you apply for disability benefits and are approved with your employer, that you contact our office, speak to one of our disability representatives, and then apply for disability benefits with our fund also. Very, very important. Because like I said, she missed out on 2 years of disability benefits and 2 years of service credit. That's a lot. Okay, so now let's talk about our minimum formula, how a pension is calculated, or what we call a formula pension. So here's the formula. So we use that 4-year final average salary that I mentioned earlier, highest four consecutive salaries out of your last 10 years worked. We multiply that by your years of service and then multiply by 2.4%. So this is how we calculate your pension. Now, there are instances, and I'll show you this in a few minutes, where your pension may end up being reduced. And I mentioned that earlier with, for example, if you're 55 years of age and you have 20 years of service, or between 20 years and less than 25, you may end up with a reduced benefit. Okay, so here's our first example of the final average salary. So here is someone who separated a couple months ago. They separated February 28th of this year. So this means that in 2022, they did not get to a full year of service. They only had a half of a year of service for 2022. Because once again, as I mentioned earlier, it takes 6 months, working 6 months in the calendar year to get the full year of credit at that point. So in this example, in order to make 4 full years for the final average salary, we had to take 2018 and treat 2018 as a half of a year. So in this case, 2018 and 2022 are each a half of a year, and we'll combine 2018 and 2022 to make 1 full year. So we take those 2 half years and combine those to make 1 full year. And then we also combine those with 2019, 2020, and 2021, and we average those 4 years. And in this instance, the 4-year final average salary ends up being $4,000 per month. Now, keep this $4,000 a month in mind, kid. Remember this number. I'm going to use this again in a minute. Here's a second example. This person is going to retire in a couple of months, June 30th of this year. Now, in this instance, they get their full year of service for 2022 because they worked 6 months in the calendar year. So in this example, I don't need 2018 because I have 4 full years of 2019, 2020, 2021, and 2022. So if you take 2019 through 2022 and add those up, divide by 4, you end up with a 4-year final average salary of $4,500 per month in this example. So here's a case where we automatically have 4 full years to work with. So keep that $4,500 a month also. Keep that in mind. I'm going to use that too. So here are 2 examples. So look at the first example here at the top. Once again, a February 28th, 2022 separation date. So this person was age 60 and they had 25 years of service. So age 60, there's no age reduction at age 60 at all. So we use that first final average salary I calculated, $4,000 times 25 years of service times 2.4%. So 4,000 times 25 times 2.4% makes a monthly pension of $2,400 per month. Another thing too to note is, you see at the bottom there, 25 times 2.4% is 60. So this person is getting 60% of $4,000 of that final average salary of $4,000. So that's how you can always find out what your percentage is going to be too. If you know how many years of service you have, take that and multiply it by 2.4, and that's the percentage you will receive of your 4-year final average salary. Look at the second example, June 30th of 2022. So this person is age 60, this time with 25 and a half years of service. So this time, 4-year final average salary, $4,500 a month, times 25 and a half years of service, times 2.4%. This makes a monthly pension of $2,754. So in this instance, with 25 and a half times 2.4%, they're getting 61.2% of the 4-year final average salary. So 61.2% of $4,500 makes $2,754 a month. So these are some examples about how we at the pension fund calculate your pension. Okay, so now I mentioned earlier potentially having a reduced pension. Here's once again where the instances where your benefit would be reduced. So if you separate between the ages of 55 and 59, and you have at least 20 years of service, but less than 25 years of service, then your pension is reduced by 0.25% for each month that you are under age 60. So I'll get into this a bit more with some examples on a chart right now, and you get to make it clearer. So here's the chart. So if I start from the bottom here, and let's do it, work with me, let's do a little bit of math. So if you're age 55, that means you are 5 years away from age 60. So 5 years is 60 months, because of course, 12 months in a year times 5 years is 60. So 5 years is 60 months, and then 1/4 of 60 is 15. So that's where the 15% comes from, because at age 55, you are 60 months away from age 60. And then as you can see, the closer you get to age 60, with every year, that reduction gets smaller and smaller. It's decreasing by 3%. If you're age 56, you're 48 months away from age 60. 1/4 of 48 is 12. If you're 57 years old at retirement, that means that you're 36 months away from age 60. 1/4 of 36 is 9, and so on and so on. So as you can see here, the closer that you are to age 60, the smaller that reduction becomes. And then of course, once again, at age 60, there is no reduction at age 60. Only between the ages of 55 and 59, if you have at least 20 years of service, but less than 25, then you end up with these reductions. So let's do some example where you can kind of see the comparison of a reduced pension and an unreduced pension. You can see the difference here. So once again, a member that retired February 28th of this year, they were age 55 and they had 20 years of service. So once again, age 55 with 20 years, this is where that reduction comes into play. So once again, 4-year final average salary is $4,000 times 20 years of service times 2.4%, but we have to take off that 15% in this example. So that's why we're multiplying it times 0.85 also. So this creates a monthly pension of $1,632 per month. So with that reduction, 20 times 2.4 and then times taking 85% of that is 40.8% of that 4-year final average salary of $4,000 a month. Now let's see the second example, a member who retires at age 60 with 20 years of service. Now, once again, at age 60, there is no reduction at age 60. So this time it's just 4,000 times 20 times 2.4. So this person is getting $1,920 a month. And so without the reduction, 20 times 2.4, they're getting 48% of that final average salary of $4,000 a month. So you can see clearly the difference between a reduced pension of $1,632 a month and an unreduced pension of $1,920 per month. So this person, they're getting person that's age 60, they're getting a pension that's approximately $300 a month more. Another example. So once again, person retiring this coming June 30th, age 55, and they get to 20 and a half years of service. So this time the final average salary is once again $4,500 times 20 and a half times 2.4, once again, taking off 15%. Their monthly pension is $1,882 a month. So with that reduction, they're getting 41.82% of that 4-year final average salary of $4,500 a month. And then in the second instance, once again, age 60 with 20 and a half years. So once again, age 60, no reduction. So $4,500 times 20 and a half times 2.4 makes a monthly pension of $2,214 a month. So with no reduction, 20 and a half times 2.4, they're getting 49.2% of the 4-year final average salary. So you can see the difference there with a reduced pension at age 55 and an unreduced pension at age 60. Okay, now let's talk about applying for your benefit. So after you have informed your department that you're resigning in a situation that you're choosing to retire and you're going to go ahead and resign, it is strongly recommended by the fund, and this is not mandatory, it's just what we call a strong recommendation, that you submit a retirement application to us approximately 2 months prior to your retirement date. So I'm telling people right now, for example, anyone who plans on retiring in June, I'm advising them to get the application in this month, because now we're in that 2-month window. So go ahead and get the application in now. But whenever you end up retiring, definitely contact our office, call us. Excuse me. We can either put a request in to have our front office mail the application to you, or we can email the application to you, or you can go to our website at any time and you can print out the application for yourself. So absolutely, you can absolutely obtain the application either from us or directly on your own. Now, here's an important note also. Now, let's say, for example, that someone is age 60 when they separate from service. So they're eligible for retirement, because once again, if you separate at age 60, you're automatically eligible. So let's say they separated age 60, but they, for whatever reason, they don't apply for pension until age 62. For whatever reason, they just wait 2 years to apply. They just didn't realize that they need to apply for pension, or they just figure, oh, I'll just apply for it whenever I need it. Well, in this instance, this is very similar to what I mentioned about the disability benefits, not only being able to be backdated for 1 year. In this instance, the pension works the same way. So if you separate from service and you are eligible for pension at the time that you separate, and then you don't apply for a couple of years for whatever reason, we can only backdate your benefits 1 year. Okay, I have seen instances like this where someone separates from service and then they don't apply for pension for 2 years. And then they're only able to get retroactive benefits going back 1 year. So in this instance, let's say that you're age 60, once again, age 60 when you separate, you don't apply until age 62. And then we're only able to take your benefits back to age 61, back 1 year prior. If your pension is $3,000 a month, you lost that on a year of pension. 3,000 times 12 is $36,000. So in this instance, this person lost out on $36,000 in pension because they waited 2 years to apply for their benefit when they separated, because they were eligible when they separated, but they did not apply for 2 years. Be mindful of that. We can only give you retroactive benefits going back 1 year. So it's very important to contact our office, find out your eligibility, review your options with a benefits counselor like myself or one of my other colleagues, one of the other benefits counselors. Absolutely stay in touch with our office and find out when you are eligible for a pension. Okay, now looking at the application process again, so there are some required supporting documents that you must submit along with your application. So I'll go through them. So one is proof of resignation. So a very common misconception is sometimes employees think that if they simply submit the application to our fund, that we're going to inform their employer that they're retiring. Doesn't work that way. You have to handle the resignation process. So you've got to submit what's called an approved resignation or retirement letter to our office along with your application. So you have to handle resignation. The pension fund doesn't handle that for you. So you've got to submit proof of your resignation, copy of your current driver's license or state ID. If you're currently married when you separate, then a copy of your marriage certificate. If you have been divorced or are widowed, we need copies of the divorce decree or the death certificate. Now, when it comes to being divorced, another common misconception is people think that we only care about divorces that took place while they were employed for CPS. That is not true. If you've been divorced 3 times, we need all 3 divorce decrees. It's not just the divorces that took place while you were an employee for CPS. We need all the divorce decrees. So be mindful of that. If you have multiple divorces, we need all the divorce decrees. Now, when it comes to the divorce decree too, we don't necessarily need the entire divorce decree because sometimes some divorces are complicated, I'll just say, and the divorce decree might be 30 pages long. Well, we don't need all 30 pages. What we do need is the first page, of course, with you and your ex-spouse's name on it, and the last couple of pages that mention that the divorce was granted, and of course, the pages with your signature and the judge's signature and the court stamp or seal. So those are the pages that we need for the divorce decree. We don't need the entire 20, 30-page document. We don't need all of that, but there are those crucial pages that we do need from the divorce decree. We also need a copy of your birth certificate or passport for you and your spouse, if you have one, and copies of your Social Security card for you and, once again, for your spouse, if you have one. And if you are signing up for direct deposit, which I strongly recommend versus having your pension checks mailed to you, if you're signing up for direct deposit, we either need a voided check or a letter from your bank in order to set up direct deposit. Okay, and also if you are in a civil union, then instead of a marriage, the requirements for this are very similar to the requirements for members who are married. Copy of the spouse's birth certificate or passport, and a copy of the civil union license if you're currently married. And if you are divorced, copy of the civil union decree or the death certificate from those marriages. Okay, now getting back to reciprocal considerations for a moment, if you do plan to retire under the provisions of the Illinois Reciprocal Act, you must, once again, as I mentioned earlier, you must complete retirement applications with both or all funds if you're retiring from more than 2 pension funds. And you must indicate on the application, each pension fund has something on one of their documents where you must indicate that you want a reciprocal retirement. So you have to declare that on the applications and then submit those applications to both or all funds. So if you're going to retire reciprocally, you must complete the paperwork with both or all of those funds. And you must indicate on those applications that you want to retire under reciprocity. Okay, so now let's talk about the reversionary annuity. I talked about this a little bit at the top. Like I said, kind of a little known topic. So there is a benefit available to members where, let's say that you have, and this is very rare, but let's say you have a disabled child and you want to leave some type of death benefit for them. And so you have the option of electing what's called the reversionary annuity. This can be used for members of your immediate family. So a spouse, a child, or a sibling, or a parent has to be a member of that immediate family, where you can choose to complete the reversionary annuity form and submit this form to our office, where you can choose to have a certain amount of money taken out of your pension check once you retire. And then once you pass away, then if the conditions are met, then the reversionary beneficiary would receive a monthly benefit from the pension fund. Like I said, this is called the reversionary annuity. Now, if you do elect the reversionary annuity, the form must be completed and in our office prior to the effective date of your pension. So let's just say, for example, that somebody retires this year on June 30th. And they're eligible for pension when they retire. So they retire June 30th. That means that the effective date of their pension is the very next day, July 1st. So if your effective date of your pension is July 1st of this year, and then you submit this form to us on July 2nd, the next day, we would not accept this form. We would send this form back to you. So this form must be in our office prior to the effective date of your pension. And it will not be accepted from you as part of the application process if the application is received, once again, after the effective date of your annuity. So yeah, if you do choose, and this is a very, very rare benefit, very, very few members elect the reversionary benefit. And when I'm finished explaining it, I think you'll understand why, but it's very, very rare. But if you do elect the reversionary benefit, yeah, we do have to have the form in our office in your application prior to the effective date of your pension. And the reversionary annuity can be canceled anytime prior to your resignation. So you can choose the reversionary annuity, and then if you change your mind before you resign, that's fine. You would just send us something in writing telling us, with your signature, telling us that you've changed your mind and you want to cancel the reversionary annuity. Now, here's the thing about the reversionary annuity is that you can choose to have, like I mentioned, you can choose to have a certain amount of money deducted from your pension checks every month. I believe the minimum amount is $50 and a maximum is $400. So you can choose to have at least $50 and up to $400 a month deducted from your monthly pension check. And then that money is used to fund the reversionary benefit upon your death. Now, the amount of money that the person would receive will depend on a couple of factors. It depends on your age and the age of the reversionary beneficiary at the time of your retirement. And it depends on the amount of money that you have chosen to have deducted out of your check. So those two things determine how much upon your death that reversionary beneficiary would receive. Now, here are a couple of things to note about the reversionary annuity. Number one is that if the reversionary beneficiary dies before you do, and then you've elected to have, let's say you've elected to have $200 a month taken out of your pension, your monthly pension checks for the reversionary beneficiary. But if that beneficiary dies before you do, that $200 a month that was coming out of your check, you do not get that money back. So that's one thing to note about the reversionary annuity, is that whatever amounts were coming out of your check and had come out of your check, and if the reversionary beneficiary dies before you do, you don't get that money back. The other thing too is that you, after retirement, you have to live a full 730 days, a full 2 years from the date that you signed the form, in order for the reversionary annuity to go into effect, in order for that person to be eligible for a benefit upon your death. So if you were to elect the reversionary annuity and then you retire, if you die 1 year, let's say 365, a full year after you retire, the reversionary annuity would not go into effect, because you did not live, in this instance, you did not live a full 730 days. You did not live a full 2 years after retirement. So because of that, in this example, the reversionary annuity would not go into effect. That beneficiary would not receive a benefit. So, as I said, the reversionary annuity is a very, very rare thing. I think in part because of a lot of these conditions that I just mentioned to you. We don't see it often at all, but it is an option available to you. Okay, now kind of winding down here. Now, one thing that is important to note too is that every member needs to have a document on file with the fund called a membership record. Now, the majority of members do, but the thing that's key about it is that if you ever contact our office and you want a pension estimate, or you want to know how many years of service you have, or how much money you currently have in spousal contributions, we can't send you any of that information unless you have a membership record on file. So if you're not sure if you have one on file, just contact the office, just call the office or send us an email, and we can let you know if you have a membership record on file or not. And in the rare instance that you don't have a membership record on file, we can easily take care of that. We can have our front office mail a membership record to you, or we can email one to you, or just like the retirement application, you can go to our website and you can print it out at any time. And then you can send that back to us. And once you have a membership record on file, then you can call us and request any information that you want on your account. Now, one thing to note about the membership record is the last page of the membership record is the designation of beneficiary form, which sets up benefits for any beneficiaries upon your death. Now, in order for that last page of the membership record to be official, that page has to be notarized in order for the beneficiary form to be valid. So just be aware of that. Okay, so then lastly, we have our contact information for our office. Our phone number is area code 312-236-4700. Fax number is 312-527-0192. You can reach us Mondays through Fridays from 8 a.m. to 4:30 p.m. You can also visit our website at any time, which is www.meabf.org. As I mentioned, you can obtain the membership record there. You can obtain the retirement application there. If you're taking a lump sum refund, you can get the refund application there. All those things are available on our website. You can also go to our website and fill out what's called an email authorization, where that gives us permission to send you correspondence via email. So for example, if you call and you want an estimate, well, if you have completed an email authorization form online, when the estimate is ready, it will not be physically mailed to you, it will be emailed to you. And anytime in the future, once you've completed the email authorization, you can get any information that you want emailed to you instead of mailed to you, because of course, email is quicker and you can avoid some of the issues that are currently going on with snail mail. And also, if you have questions, in addition to calling us at the 312-236-4700, you can also send an email to info@meabf.org. You can email us at that address, and we will respond to you as soon as possible and answer your questions. Okay, so I want to thank you for your time and attention. And I'm going to take some time and answer some questions that we've got. I'll answer as many of these as I can. And keep in mind that I can answer general questions, but anything that requires us to open up your account and it's very specific, I can't answer that here. But by all means, call our office tomorrow, call our office this week, and we'll be more than happy to help you. Okay, so let's see. First question from Jesus. Hi, Jesus. He says, where do I update my beneficiaries? Very good question. So you've got to complete what's called the designation of beneficiary form. So just like the membership record, I should have mentioned this a second ago, just like the membership record, just like the retirement application, you can obtain the designation of beneficiary form online, or once again, contact our office and we can have our front office mail you the beneficiary form, or we can email it to you, kind of whatever works for you. We'll mail it to you, we'll email it to you, or you can go to our website and print it out. Now, as I mentioned a second ago, the form does have to be notarized in order for it to be valid. Okay, question from Janet. Hi, Janet. Our sick days grandfathered in before 2012, are they paid out in cash? This is a CPS question. So the pension fund does not pay out sick days or vacation days. So that is a CPS question. From what I know of the teachers, I used to work at the teachers pension fund, there is a payout, and it depends on how much it is versus whether or not it's a cash payout or if it's going to be a rollover. But you can definitely contact CPS for the details about grandfathered sick day payout. Okay, Yolanda has a question. Hi, Yolanda. What percentage do you get when you retire at 55 with 25 years? So I kind of went over this earlier. So at 25 years of service, there is no, and at age 55, there is no reduction at age 55 with 25 years. So 25 times 2.4 is 60. So 25 times 2.4 giving you 60% of your 4-year final average salary. So as I mentioned earlier, if you want to know what your percentage will be, then you could always just take your years of service and multiply it by 2.4, and that will tell you the percentage that you're going to receive. And as long as, if you're between the ages of 55 and 59, as long as you have at least 25 years of service, there's not going to be a reduction. Question from Judith. Hi, Judith. Can I put my spousal refund into an IRA? Absolutely. Yes, you can put, it's called a rollover. You would roll it over into a tax deferred account. So in the retirement application, one of the forms is what's called the election form for we call it the no spouse refund or the spousal contributions. So on that form, as part of the retirement application, you'll just check the box that says that you want to do a rollover, and you'll indicate what the name of the financial institution. What will happen is once you receive that check, the check will be mailed to you, and the check will be made payable to that institution. And then it will be up to you, your responsibility, to deposit that check with that institution. A lot of times people think that we mail the check directly to the institution. We don't. We mail the check to you, and then the check will then go to the institution. You'll take it to the institution. Let's see. Question from Luis. Hi, Luis. I may have to run, but I want to ask a question that I hope we recorded. Hired in 2002, considered tier 1. That's true. I'll be 51 when I reach 30 years of service. Will I be eligible for the 80%, or will I have to work for 33 years? As I mentioned earlier, you can only reach the maximum benefit with tier 1 at 33 and a half years of service. So you have to get to 33 and a half years of service in order to, in order to reach the maximum benefit of the 80%. York has a question. Hi, York. What is the COLA for tier 2? That's a great question. For tier 2 members, it's not a certain percentage. It is half of the consumer price index. So that's how the COLA works for tier 2. Let's see. Anonymous person asked a question. Hi, Anonymous. Are CPS employees monthly pay, I guess they mean paid monthly, to determine pension based on a 12-month salary or the 10-month school year salary? So actually neither. What we do is we look to see if you worked 6 months in we go by calendar years. So we look at calendar years and we look to see if you worked 6 months in the calendar year. If you work 6 months in the calendar year, you get the full year of credit. And so we average your salary that way. We're only looking for 6 months of work to see if you have a full year of service. Okay, question from Delphine. Hi, Delphine. Can you please speak about health insurance? There's not a lot to say as far as health insurance goes. There's no health insurance, unfortunately, offered through the pension fund. So if you're under age 65 when you retire, you do have the option of speaking to your employer about COBRA, and you can be on COBRA through your employer. You sign up through your employer. COBRA lasts up to 18 months. So you have that option available to you, or you can choose to, if instead of taking COBRA, because people sometimes consider COBRA to be kind of expensive. So if you don't want to elect COBRA and you're under age 65, you have the option of simply getting your own insurance. A lot of people go to the healthcare.gov, the Obamacare website, and they look at plans and they choose a plan that works for them that way. Another option is potentially is if you are married, then you could look into becoming a dependent on your spouse's insurance. If you're 65 or older when you retire, the typical option is Medicare. So you would typically sign up for Medicare 3 months prior to your retirement. You might have Part A already, but then you would want to sign up for Part B also. And then you would want to look into signing up for some type of Medicare supplemental insurance to go along with your Part A and your Part B, because Part A and Part B only cover 80% of expenses. And then that Medicare supplement or Medicare Advantage plan fills that gap. And then you are fully covered at that point. So let's see. Let's see. So question from Judy. Hi, Judy. Upon retirement, what happens to our accrued sick days? So once again, that's a CPS question. You'd have to talk to CPS about any kind of a sick day payout, because once again, at the pension fund, we're not involved in any kind of sick day payout. Question from Anonymous. Hi, Anonymous. Can we make an appointment to come in to see a representative? So currently the office is still closed to the public. We have not reopened to the public just yet. Not sure when that will happen exactly, but you can absolutely make an appointment for a phone consultation. I do tons of those all the time. So you can call and request a phone consultation with a counselor. That's not a problem at all. Question from Lawrence. Hi, Lawrence. What about SSA, Social Security Administration benefit reduction? Is there a formula? There's a formula, but we're not involved in that. That's something you would speak to the Social Security Administration about. And this is a very common topic because, as many of you know, I'm sure, while you work for CPS, you're not contributing to Social Security. So this does not affect your pension, but it can potentially affect your Social Security benefits. They typically have two situations. One where if you're eligible for a Social Security benefit based on your own contributions, you may be subject to something called the windfall elimination provision. That's where they would reduce your Social Security benefit. Once again, your pension is not affected, but your Social Security benefit may be affected. But you would talk to Social Security about that and get those details from them. The other instance is if you're going to receive a Social Security benefit based on your spouse's contributions, then you may be subject to what's called the government pension offset, where they reduce your Social Security benefit by 2/3 of your pension. So, you can fall into those kinds of situations, but to get specific details on your situation, you would have to contact Social Security and go over that with them. Let's see. Question from Cecilia. Hi, Cecilia. Does my spouse receive a pension from my pension? Only in the event of your death. Like I said, your spouse is eligible, generally speaking, to half of your benefit for the rest of their life. Or you could sign up for the reversionary benefit, like I mentioned earlier. The other thing, and don't really see this often, I think I might have seen this once, is through what's called a KILDRO. It's an acronym, QILDRO, stands for Qualified Illinois Domestic Relations Order. Typically, KILDROs are seen in divorces where the ex-spouse wants a piece of the member's pension, but technically, a current spouse can sign up for a KILDRO. I think I've seen it one time, but that's incredibly rare. But those are the instances in which a spouse is entitled to a benefit. But outside of a KILDRO, the only benefit that's available is upon your death, either from the reversionary annuity, and in addition to that, the kind of normal spousal benefit upon your death. Question from Susanna. Hi, Susanna. If I retire, does my husband qualify for credits to him? No, your husband is totally separate. Has nothing to do with your pension. If your husband is a member, then he has his own situation. But just because you retire, there's no automatic benefit to a spouse. It doesn't work that way. Things don't work that way. Question from Adriana. Hi, Adriana. I became a teacher, I'll assume, recently. What happens to my MEABF pension? That's a great question. So once again, as long as you have at least 1 year of service with this fund and then are become eligible for retirement under the Chicago Teachers Pension Fund, because once you're a teacher, you move over to the Chicago Teachers Pension Fund and you earn service with them, then you're potentially eligible for a reciprocal retirement. Okay, question from Myrta. If you want to know the estimation of retirement, are we taking appointments in person? Not, as I mentioned earlier, not yet. Like I said, but you can absolutely call the office. We can either mail an estimate to you or email it to you if you go online to our website and complete the email authorization form, or we can speak to you on the phone and give you information on the phone. We can definitely do either of those things. Question from Anonymous. Hi, Anonymous. If I plan to retire in June 2023, do I file the papers in November 2022? That's a little early because that's about 7 months. Yeah, that's 7 months ahead. And normally the applications are only good for 6 months. So you don't want to submit that early. But if you plan to retire in June, if you want to submit the paperwork in January or February, that's fine. Like I said, the general advice we give is 2 months prior. But if you were to submit it 4 or 5 months earlier, that's fine too. But you don't want to submit it any further or any more than 6 months ahead of time, because like I said, the application is only good for 6 months. Question from Willette. Hi, Willette. I have 33 years of service. I will be retiring on June 16th. I am 59. What is my percentage? So as I mentioned earlier, you can always take the years of service and multiply it times 2.4 in order to obtain what your percentage will be. So unfortunately, at the moment, I don't have my calculator with me, but 33 times 2.4, you're very, very close to 80%. I can't say off the top of my head exactly what it is, but that's very, very close to 80% of the benefit. Because at 33 and a half years, that's when you reach the maximum benefit of the 33.5%. So you're very, very close to it. Question from Valerie. Hi, Valerie. Can I designate my adult son as my beneficiary? You absolutely can. Now, the thing to note about the beneficiary form is that, and beneficiaries entirely is that, aside from a spouse, now, when it comes to the beneficiary, if you are married, your spouse is your automatic beneficiary. So they take the place of anybody if you are married. Now, if you're not married, you absolutely can designate your son as a beneficiary. Now, if you are married, though, you can have him as a backup. You can definitely do that. But if you are married, the spouse is the automatic beneficiary. If you're not married, you can absolutely do that. Now, one thing to know, too, about beneficiaries is that once you retire, you're paid out of the money that you contributed for approximately the first 2 to 3 years. And then you're paid out of the fund's money. Now, so at that point, there is no death benefit, typically, aside from a spousal benefit. There is no lump sum benefit if you pass away, let's say 5 years after you retire. So you pass away 5 years after you retire, there's no spouse. So at that point, in that scenario, there is no death benefit, actually, because you've exhausted at that point all the money that you put in. And in that scenario, you don't have a spouse. So there wouldn't be a death benefit in that scenario if you retire and then you pass away more than 3 years after you retire. So let's see, another question. So let's see, hi, Anonymous. When does the COLA start if you're retiring at age 56 with 25 years of service? So the 25 years has nothing to do with the COLA. COLA is directly related to your age at retirement. So this is another situation where they would have to wait if it's this year, they would wait for the 3 years, the third anniversary of their retirement before the COLA would kick in. So if somebody's retiring this year at age 56, they're going to have to wait until January of 2025 in order for the COLA to kick in. They would have to wait the 3 years in order for the COLA to kick in. Question from Joy. Hi, Joy. Can I take my annuity in one large sum, or do I have to take it monthly? As I mentioned earlier, if you separate from service and you are eligible for retirement, and if your pension would be at least $800 per month, by law, you have to take the pension. Okay, you can only take a lump sum instead if you separate from service and you're eligible for retirement, if the pension would be less than $800 per month, or if you separate from service and you're not pension eligible, you haven't reached the age requirement. In that instance, you can take a lump sum benefit, but I want to be very clear about this. When you take a lump sum benefit instead of taking a pension, you are no longer at that point. You are not entitled to future benefits. That's it. That's all you get. I have had some conversations with people over the years where they call inquiring about retirement, but they took a refund years earlier. And I have to explain to them that they're not eligible for retirement because they already took their money out. So just be mindful of that. If you do take a lump sum refund, you are not eligible for future benefits because you're receiving your money at that point. And as I mentioned earlier too, you are forfeiting your years of service at that point also. So be aware of the consequences of taking a lump sum refund. Let's see, got any other questions? Okay, so let's see, question from Sandra. Hi, Sandra. Do you use our check stub to calculate? We do not. We use payroll data submitted to us from your employer. That's what we use to calculate your pension. Question from Valerie. Hi, Valerie. Is the average monthly salary based on gross or net pay? It is based on gross pay. Gross pay plus the pension pickup, as I mentioned earlier. So, for example, if you're in a position where it's a 2%, 7% split, for example, in terms of pension contributions, we take your salary and multiply it by 7% to include that CPS pension pickup. So that's what we would call your pensionable salary. So that's what we do when we calculate your pension. Question from Anonymous. Hi, Anonymous. Can we meet with a pension rep prior to resigning from CPS to make sure we are maximizing our pension benefits before signing the dotted line? As I mentioned earlier, absolutely call our office and speak to a benefits counselor. Like I said, currently, we're not seeing people in person, but we can absolutely speak to you on the phone and answer all of your questions. So yes, definitely call our office, 312-236-4700, and you can absolutely speak to a benefits counselor. Definitely. Question from Anonymous. Hi, Anonymous. I have 2.5 years in the CTPF, Chicago Teachers Pension Fund, approximately 10 grand. Can I roll it into my MEAB pension fund? It is just sitting there, not accruing any interest. Well, unfortunately, you can't. Now, some reciprocal funds do accept contributions from other pension funds, but the municipal fund does not. So you cannot, unfortunately, roll the money into our fund, but maybe you qualify for reciprocity, as I mentioned earlier, where since it's more than 1 year of service with CTPF, where in the future, when you're retirement eligible, you could take your years of service with our fund and then combine it with the 2.5 years with the teacher's pension fund. And then you would be eligible for potentially be eligible for a reciprocal retirement and get 2 pension checks. Okay, Sabrina has a question. Hi, Sabrina. I am 51 with 28 years of service. I am ready to retire, she says with an exclamation point. So I think she means it. What are my options? Well, Sabrina, you currently cannot retire and start collecting a benefit at the moment because you don't meet the age requirement or the years of service requirement to retire now. If you had 30 years of service, you would be eligible now. Or if you were age 55, you could retire now. But 51 with 28 years, you can't start collecting a benefit. What you could do is separate from service and then defer your pension until the age of 55, as I mentioned earlier. So you can choose to defer if you separate from employment, or you could work 2 more years and get to 38 to 30 years of service, and then you would be eligible. So currently you're not eligible for retirement, but you do have the option to work to get 30 years of service or choose to defer your pension until the age of 55. And it'd be a good idea, call our office, request an estimate. We can work up an estimate for you for both scenarios, and we can send that to you. That's not a problem. Another question from Anonymous. Hi, Anonymous. So do we mail in the application when we complete it, since your office is not open at this time? That's one option. You can mail the application in. You can fax the application to us. I showed you the fax number earlier. Or you can scan an email to the retirement application processor, the person that's going to be working on your application. So you can contact our office to get their email address. You could even contact the office to get their particular fax number. What I showed you earlier was the generic fax number, which is fine. You can use that. But if you want the application processor's personal fax number, you can actually call and get that information. So yes, you can mail the application, or you can fax it, or you can scan an email. Another question from Anonymous. Hi, Anonymous. If one separates from CPS before retirement age, what happens to our contributions to the pension? Well, as I mentioned earlier, if you are eligible, if you're vested, what's called deferred vested, if you are vested, you can choose to defer your pension until either age 55 or age 60, whatever your situation is. Or if you're not vested, then the only option you have is to take a lump sum refund of your contributions. So if you want specific information on your situation, contact our office. We will send you an estimate and tell you what your options are. Okay, York has another question. Hey, hi again, York. If we worked in the private sector, I know there is a reduction to the Social Security benefits due to the windfall elimination provision when we receive pensions. Is there any reduction on the pension side if we receive any Social Security? No, there is no effect on your pension based on Social Security. But as I said earlier, the reverse can be true. Your Social Security can be, not will be, but can be affected by your pension. But no, your pension is not affected by Social Security, or affected, I should say. So let's see. Question from Galaxy A12. Hi, Galaxy. So if I retire at 60 years of age with 30 years of service, what percentage will I receive? 60 or 80? Once again, to get your percentage, always take your years of service and multiply by 2.4. So 30 times 2.4 is 72. So 30 years of service means 72% of the 4-year final average salary. Question from Janice. Hi, Janice. How is my salary calculated if my salary changes in July and I retire in November? Well, that's a good question. So what we do is we average out the year. So we'll take a certain number of pay periods at however many pay periods there are from January through July. And then we'll take however many pay periods there are from July to November, and we'll average it all out. So yeah, that's very common. If a member has a salary change during the year, we do average it out. Another question from Anonymous. Second question. I hear you don't pay state taxes on pension checks. Is this correct? Here in Illinois, this is true. Under the current laws, you pay federal taxes on your pension, but here in Illinois, you don't pay any state taxes on your pension. However, if you move to once you retire, if you move to a state that does tax pensions, you would have to pay state taxes in that instance. But yes, currently here in Illinois, there are no state taxes on pension. Hi, Anonymous. A question from Anonymous. Contact information again? Sure. So the pension fund, our phone number is 312-236-4700. So 312-236-4700. The office is open Monday through Friday from 8 a.m. to 4:30 p.m. So you can call during business hours, talk to a counselor, get your questions answered. And as I mentioned earlier, you can also email us at info@meabf.org. So you can call us or you can send us an email. Another question from Anonymous. Hi, Anonymous. When the person who retires is single, does she or he receive the life insurance money? Well, the pension fund is not involved in any kind of life insurance, so that's a totally separate topic. We have nothing to do with any kind of life insurance. Another question from Anonymous. Hi, Anonymous. I have 33 years of service and I am 59. I will retire in June. Will I get my full pension? Well, it sounds like, but I can't confirm this for sure because, of course, I can't open up your account. It sounds like you would get to 33 and a half years of service in June. Sounds like it. If that's the case, then yes, you would receive the maximum benefit of 80% of your 4-year final average salary. The best thing to do, contact the office, call us, email us, get an estimate, and we can tell you what you would receive in June and if that would be the maximum benefit. We can absolutely, you can absolutely do that. This is a great question from Charlotte. Hi, Charlotte. Can we come back as a sub and get our pension? The answer is no. So coming back with this fund, because this fund covers CPS support staff and also City of Chicago employees, there is no part-time work allowed. So you can't come back and work any job that would fall under this pension fund and collect the pension. So if it's a job that would fall under this pension fund, you cannot have that job and collect the pension. Excuse me. Question from Lynetta. Hi, Lynetta. What if I work for a charter school in Chicago? Well, a charter school very likely falls under the Chicago Teachers Pension Fund. So I would say contact them. So the phone number for CTPF is 312-641-4464. So contact the Chicago Teachers Pension Fund and find out from them if you have any service time with them with a charter school. And once again, if it's at least 1 year of service, that is time you could potentially combine together and retire reciprocally. Question from Kate. Hi, Kate. I was a crossing guard with CPD for 5 years. Is that the same fund? Potentially. I mean, crossing guards are in this fund, so very likely you are, but absolutely call our office. We can look up to see if we have an account for you. Let's see. Question from Anonymous. Hi, Anonymous. Oh, let's see. I will have 20 years in June 2023. I am 63 and a half. I thought there was an actual question there. I'm sorry. Hopefully they'll come back and finish their thought. Question from Susanna. Hi, Susanna. If I resign June 30th of this year, there is no penalty because the school year is, I assume she's asking if there's a penalty. There's not a penalty involved in that at all. But what we generally recommend, and this is just, like I said, general advice that we give to members, is to retire at the end of the month because your pension cannot be effective in the same month that you're working. So if you're able to work until June 30th, then that's our recommendation, is to retire that date. I have spoken to 1 or 2 people that said that their last day is going to be June 18th. So, and they can't do anything about that. So if your last day is June 18th, and that's the last day you can work this year, then that's your resignation date. Let's see. What question from Anonymous? Hi, Anonymous. My husband receives SSI. Will his SSI check be affected if he receives a part of my pension? That is a question for Social Security. Question from Jesus. Hi, Jesus. Let's say you give 20 years of service and are not age eligible. You're under 50, okay? But you go work elsewhere outside CPS for a couple of years, okay? You can leave your money in the pension until you reach a minimum age of 55 to apply for your benefits. That is true. He's asking. That is true. Is it correct, but you could apply at age 54? No, not at age 54. If you have 20 years of service, then you can either defer your pension until age 55 and take that reduced benefit, like those examples I showed you earlier, or you can choose to avoid that 15% penalty and then defer your pension until age 60. So you can only apply at age or be eligible at age 54 if you have 30 years of service. Let's see. Question from Sheila. Hi, Sheila. She says she tuned in late. That's okay. If I'm not married, can I take my spousal money without rolling it over? You absolutely can. But as I mentioned earlier, there are tax implications on that. It's your decision, of course, but just be aware that if you choose to have the money, the spousal contributions made payable to yourself, there is an automatic 20% tax penalty taken off the top. Okay, so be aware of that. And if you're under age 59 and a half at the time that you take the refund, there is potentially an additional 10% penalty when you file your taxes the next year. The advice I always give to members is to discuss the spousal money. Discuss this with your tax advisor, because your tax advisor knows your financial situation and they can give you the best advice as to whether or not you should take the lump sum and have it made payable to yourself and go ahead and deal with the tax implications now, or if it's better to roll the money over into a tax deferred account and deal with the tax implications later. All right, Monica has a question. Hi, Monica. How do we set up an appointment? Well, as I mentioned earlier, call us at 312-236-4700, or you can send an email to info@meabf.org. You can do either of those two things to set up an appointment with a counselor. Absolutely. Question from Anonymous. Hi, Anonymous. If I retire at age 60, do I still need to wait 3 years for the COLA? No. The 3-year wait is only for members who retire in their early to mid 50s. But if you are age 60, if you're age 59 or older, as long as you retire by November 30th of that year, you will begin receiving the COLA the following January after you retire. So as I mentioned earlier, if you retire this year at age 59 or older, or if in this example, you retire this year at age 60, as long as you retire by November 30th, you will begin receiving the COLA January of 2023. Question from Marbella. Hi, Marbella. If we defer our pension after 10 years, will we have credit for those years if we return to CPS? The answer is yes, as long as you don't take a refund of your contributions. As long as you leave your contributions with the fund, you keep your service credit. You don't lose anything. It just sits there essentially. But if you take a refund of your contributions, you lose your years of service. So as long as you don't do that, then yes, you still have your time. All right, let's see. Somebody with a compliment. Thank you very much for tuning in. Oh, question from Monica again, a good question. Hi again, Monica. How long does it take to receive an estimate? Estimates typically take 3 to 4 weeks. Now, if it's a reciprocal estimate where we have to reach out to one or more pension funds, that can take longer, but the typical time frame for an estimate is 3 to 4 weeks. Now, I will admit, we are a bit shorthanded these days. So in some instances, it might take up to 6 weeks to get an estimate. So just kind of be ready for that. We're trying to get things out as fast as we can. But like I said, typical time frame, 3 to 4 weeks, but don't be surprised if it takes up to 6 weeks to get an estimate. Question from Anonymous. Hi, Anonymous. I am 63 years old with 22 years of service. Can I retire or do I have to wait more time, and how long? No, if you are age 60 or older, you are eligible for retirement. So if you want to retire, contact our office, get an estimate, have a consultation with a benefits counselor and get your questions answered. But yes, if you are 60 years of age or older, you are automatic, and you're still working, and then you separate, you are automatically eligible for retirement. All right, Monica's back with another question. Do we combine the years if you've contributed to both the Chicago Teachers Pension Fund and here? Yes, potentially you can. As I mentioned earlier, that's called reciprocity. So as long as you have at least 1 year of service with each fund, then potentially you can combine those years together. If you're currently with us, you can, once again, contact our office. We can give you what's called a reciprocal pension estimate. And that estimate will tell you how much both funds would pay you, how much our fund would pay you, and how much the teacher's pension fund would pay you. Question from Marion. Hi, Marion. Our sub is in the teacher fund. Yes, if we're talking about a substitute teacher, yes. The substitute teachers do contribute to the Chicago Teachers Pension Fund. Let's see. Question from Galaxy A6. Hi, Galaxy. Oh, this is Carolyn. Hi, Carolyn. 55 with 22 years of service. Do I need to wait 3 years before retiring to get full benefits? Well, Carolyn, our definition of full benefits is 33 and a half years of service. So if you have 22 years of service, you're 11 and a half years away from that. So we consider full benefits to be the maximum of 33 and a half years of service. All right, so I think that wraps up our Q&A here. I want to thank you all so much for your time and your attention and for being here. I hope you found this very informative. And once again, contact our office, get an estimate, get your questions answered. Don't make any decisions about retiring until you have spoken with us. So Jack, I'm going to turn things back over to you.
Jack, you're muted.
Stop.
Jack, you're muted.
Thank you, Lateef. Just want to tell you that again, as always, your presentation was informative and educational, and we had a lot of good questions, and thank you for answering them. I appreciate you, Lateef, and I appreciate the services of the Chicago Municipal Fund offers to our members. And we look forward to you working with us again. And
Absolutely.
Hopefully we'll have another presentation in June. And I'd like to thank the Chicago Teachers Union for allowing us to have this presentation, and especially to the leadership of the Chicago Teachers Union and to the members of the Chicago Teachers Pension Fund. And I'm sorry, and members of, not Chicago Teachers Pension, I'm sorry, the Chicago Pension Insurance Committee, CTU Pension Insurance Committee. So thank you again, everyone, and thank you for coming. And if you need to
read one thing I want to ask Mr. Moody before we leave.
Sure.
Sure, Mr. Moody, I would like you to answer this question for our members. During our insurance, and every year we have to choose what insurance we're going to have. They're always offering disability. Could you explain that process as far as our municipal goes, that we don't need to buy extra disability insurance? Because
the only thing I can really say about that is it's good as far as disability goes. We only are involved in disability in terms of members who, as I mentioned earlier, are eligible for either what's called ordinary disability or duty disability. That's what we're involved in as far as disability goes. Someone who has some type of injury or accident that's either related to their job or not related to their job, and they apply for disability benefits through their employer, and then they should also contact our fund to apply for disability benefits with us so that they continue earning service credit while they're on disability and receive disability benefits from the fund also. That's all I can speak to as far as disability goes. That's all we're involved in.
Thank you very much. I appreciate that.
No problem.
I just want to say before we sign off, if you have other questions, you can reach Mr. Moody at the Chicago Municipal Fund, and you can also reach me. My email is jacksilver1@gmail.com. Okay. So thank you again for coming today, and we're looking forward to seeing you again. And we'll be having another presentation.
All right.
Thank you, Mr. Moody. It was awesome. Thank you.
Thank you.
And to all the members that came, we had a strong presence today. I'm so happy. I'm glad you guys asked for it, and we tried to get you what you needed.